You remember 2008, right? When the entire global financial system just seemed to be on the verge of complete collapse, it felt like chaos. But what if I told you that one of the best tools we have for understanding that chaos, for making sense of it, actually came from a Nobel Prize-winning paper written decades earlier? Well, today, we are going to unpack that very model, the Diamond-Dybvig model, and we're going to build it from the ground up to see exactly how banks can be both the heroes and, sometimes, the villains of our economy.
See, the whole model starts with this fundamental puzzle that really defines modern finance. On one hand, banks are these incredible engines for growth. I mean, they take our savings and they fund the long-term investments that build our world. But on the other hand, they are just inherently fragile, so vulnerable to these sudden, self-fulfilling panics. So the question is, how can both of these things be true at the exact same time?
To get to the bottom of that, we're going to go on a little journey. We'll start by looking at the basic economic problem. Then we'll imagine a world with no banks at all, and from there, we'll try to design a perfect system. Only then can we really see how a bank tries to create that perfection, and, crucially, where its hidden fatal flaw really lies.
Okay, so first things first. We have to understand the basic tension that sits at the very heart of the economy. Think of it as a conflict between patient capital, money that needs time to grow, and our own unpredictable, sometimes urgent needs for cash.
So, to explore this, let's build a very simple, tiny universe. Imagine there are just 3 moments in time. Today, which we'll call period 0, tomorrow, period 1, and the day after, period 2. We all start with 1 unit of savings today. Now, we can put that into a long-term project. If we need to pull our money out tomorrow, in period 1, we just get our 1 unit back. No harm, no foul. But if we can wait until period 2, the investment matures and pays out a return, R. And the key here, as you can see, is that R is greater than 1. That's the reward for being patient.
But here is the real kicker. We're not all the same. The model says some fraction of us, let's call it theta, will suddenly find out they're impatient. They just need their cash tomorrow, period 1. The rest of us are patient, and we can afford to wait. And here is the most important part. When we all make that initial investment, nobody has any idea which type they're going to turn out to be.
So with that world all set up, what would happen if there were no banks, no financial markets, nothing, just everyone for themselves? This is a scenario that economists call autarky.
Well, the outcome is pretty simple. If you find out you're impatient, you cash out your project early, you consume your 1 unit. If you're patient, you wait, you get that big payoff, R. It works, I guess, but it's not great. It's really inefficient. There's no way to share risk, the impatient people are just stuck with a low return, the patient get their high return, and everyone is just left to their own fate. This is our baseline. This is the world we need to try and improve on.
All right, so now let's play God for a second. Let's imagine we could design the perfect system. If some all-knowing social planner could see exactly who is going to be patient and who is going to be impatient, what would be the absolute best, most efficient way to set things up to make everyone as happy as possible?
The ideal solution is basically insurance. The patient people, the ones who can wait, they would agree to give up just a little piece of their final payout to help the impatient folks. So as you can see in the table, this means the impatient get to consume an amount star O1 that's actually greater than 1, and the patient get star B2, which is a little bit less than the full R they would have gotten otherwise. By pooling resources and sharing the risk, we create a safety net, and on average, before anyone knows their type, everyone is better off.
But of course, in the real world, we don't have an all-knowing social planner. So how can a market, a real institution, actually achieve this perfect insurance arrangement? Well, you guessed it. This is where the bank finally comes in. And here's the magic. The bank offers a brilliantly simple deal. It's a deposit contract. It says, hey, give us your 1 unit. If it turns out you're impatient, no problem. You can withdraw that optimal amount we just calculated, C star A1, tomorrow. If you're patient, just hang on, and you can get your share, C star B2, the day after. It perfectly mimics the ideal insurance scheme. And just like that, boom, the bank creates prosperity. This arrangement is what we call a stable equilibrium. Impatient people withdraw early, just as they should, and the patient people, they are perfectly happy to wait because they know they're going to get a better return. Society achieves the best possible outcome. This is the good equilibrium.
But, and this is a huge but, this is where the story takes a really dramatic turn. The very thing that makes the bank so great, its ability to provide this wonderful insurance by promising more than 1 unit to early withdrawers, this is also its Achilles heel. It creates a deep, profound vulnerability.
So this brings us to the million-dollar question. This stable, prosperous outcome we just described, is it the only possible one? Is it a guarantee?
And the shocking answer is no, not even close. There is another, perfectly stable, perfectly logical equilibrium, the bank run. And a run isn't just irrational chaos, it's a cold, calculated, self-fulfilling prophecy.
Let's walk through the twisted logic here. Put yourself in the shoes of a patient depositor. You would prefer to wait. But you start to believe, for whatever reason, that all the other patient depositors are about to rush to the bank. You know the bank's assets are tied up in that long-term project. You know it's first come, first served. If they all run and pull their money out, there will be absolutely nothing left for you in period 2. So what is your only rational choice? You have to run too. You join the line, hoping to get something instead of a guaranteed nothing. And this reveals the bank's inherent fragility. The crazy thing is, the bank is totally solvent. Its assets are fine, but a simple shift in beliefs can trigger a total collapse. So the whole goal of modern banking policy is to design systems that get rid of this bad run equilibrium, to make the good equilibrium the only possible outcome.
And there's a pretty standard toolkit to do this. First, the bank can just suspend payments. It basically says, look, we'll only serve the normal number of early withdrawers, and that immediately removes the incentive for patient people to panic. Second, you can have a central bank act as a lender of last resort, ready to provide emergency loans so the bank doesn't have to sell its assets in a fire sale. And third, the big one, government deposit insurance. This is a game changer. If you know your money is safe no matter what, you have absolutely no reason to run in the first place.
So why does this model from 1983 still matter so much? Because the 2008 crisis wasn't a run on traditional everyday banks. It was a run on the shadow banking system. We're talking about institutions like investment banks, money market funds, places that acted like banks, using short-term debt to fund long-term assets, but they did it without the safeguards like deposit insurance. The run was exactly the same, just in a different part of the system.
And this all leads us to the final, really crucial question for today. We've built all these regulations to protect traditional banks, but finance never stands still. So has the fundamental fragility that Diamond-Dybvig identified all those years ago, has it actually been solved? Or has it just moved, shape-shifting into new, unregulated corners of the financial system, just waiting for the next crisis of belief? Honestly, that's the question that keeps regulators up at night.